Welcome to Erik Penser Bank. My name is Jonas Thulin. I'm head of asset management, and I will briefly go through what we think is quite important and how we changed our portfolios. Because we have made some changes, quite, I would even call them quite dramatic changes. We are virtually all in terms of equities. We have a few percentage left that we pretty much left for drifting. We have had, as I point here in red, quite big downside protections. They are mostly gone. We started making this shift on the 9th of March, and we were done with the shifts last week. Fortunate enough, in time to enjoy the upside momentum in the equity market. Now we try to derive and explain why we made this change, because obviously the horrible war and the disturbing war actions from Russia are of course with us still. But in terms of markets, there's another view out there, or could be wrong, but in a sense, but also it seems like the market has fallen back to trade on the things that we were trading on before the war. And I will actually show you how that is derived from data. This means that we are back to trading a sharply accelerating global business cycle again. Obviously, it's not accelerating as much in Europe. We are still all out of Eurozone equities, but we have shifted back to Sweden, and we have bought more in the US. And you can see it from our text that we are again trading this super cycle, as I call it. And we're taking off the hedges. Now this might sound a bit naive almost, but it actually mirrors the historical trading patterns from armed conflicts as well. So it's not that unique, I think. And we can see from flows that we're certainly not alone in this thinking. But let me derive how we came to this conclusion. Now first of all, geopolitical risk is severely high. However, the explanatory power between geopolitical risk and the equity market has diminished quite aggressively. We were building up this stress, we were building up hedges, we were taking out a lot of positions, preparing for armed conflict back in late January, early February. We were all done on the 24th of February. And then we sort of, our portfolios fared quite well in this period. As of now, the link between geopolitical risk and the equity market is falling quite rapidly. What also changed in this time period is that inflation became a theme. It was not a theme in the beginning of the year, but definitely during the build-up and through the course of the beginning stages of the war. But note how the explanatory power between short-term inflation and the equity market has shifted away. And obviously, a reason for this, I tried to highlight here on the right-hand side, where we look at electricity prices in Europe. You have Germany, France, and Nordics, where you can see how the futures were trading before the war, how we were trading as the war broke out, and what the future curve looks like right now. Now, we're not back on the same curve yet, but the difference or the delta between, for example, in Sweden on the July contract is not that massive anymore. And certainly we should be talking a lot about how the future prices of electricity will come down rather than in media, I would say, or always are, we're much more concerned about the negative story. But this also means there is another explanatory power out there that derives how the market is trading. That explanatory power is the same that was running the day or running the scheme back in January, and that is political risk in the US. Political risk in the US is improving quite aggressively. There are a number of reasons for this. One, Biden has made a small comeback versus Trump in national polls. And also the Democratic leadership has resigned to the idea that the Republicans would take over the entire Congress. And therefore, there's a bit more of a mutual understanding or mutual collaboration in terms of policies, how you nominate Fed nominees, for example. That has created a spark for the equity market. This means that political risk, or the political solutions you could even call it, in the US, has triggered a rising relationship between the equity market. Now that means that we have shifted from geopolitical risk, going into inflation risk, going to political risk. Now for us, this is quite interesting, because then we need just to time the equity market and find the trough. And I will show you how we derived the trough in the equity market. And I'm skipping a few slides. Basically, We're using the same contracts in the equity market that we used to pinpoint the bottom in the equity market on 24th of March 2020. We put our heads out on the 9th of March, calling an equity bottom. You could argue that we were wrong given what happened on the 15th, but we hold on to our positions. The black here, dark gray line, is virtually a combined index of the most stressed contracts in terms of liquidity that are out there. And as such, we got this relief rally that we at least think to understand who we should avoid trading with or who we should avoid investing with in order to avoid the biggest downfalls from the Ukrainian war or the Russian war. That created a calm in the market. And we started trading on other macro variables, i.e. political risk. That itself made that we had to sort of get rid of the war-induced pressure in the financing contracts, vol curves, etc., etc. The signal was on the 9th. We acted, put in a lot of the dry capital, a lot of the cash we had on the sidelines, kept a few hedges, actually most of them, which was good given what happened on the 15th. And then last week, we took away a lot of the hedges as well. So far, it has turned out to be a good call. Not as clean-cut as the 24th of March, which was a lot more clean-cut day. The reason for that is that we are dealing with a war which is actually it's harder to predict than the pandemic was. And we'll probably keep that small hedge for a little time to come. But we should note that the hedge is about 2.5–3% of the entire portfolio, so it's more on the surface. So obviously we're enjoying this kind of relief rally we've seen, and we're back to conditions now in the market that we saw before the war, that we had to work with as we went into the new year, etc., etc. We're trading on the same macro story that we were trading on in the beginning of the year, i.e. not inflation. We're not trading on geopolitical risk anymore, right or wrong. We're back on trading political risk. And we have also seen a great degree of calmness coming into the market. And we interpret this from basically how the market is trading. Very stressful contracts in terms of dollar liquidity, treasury liquidity, currency basis, etc., etc. So I'll leave you with those thoughts. For us, it's a huge change in the portfolios. We will update, now it's going to be 2 weeks until we give you the next update. But from then we will be, every week we give you an update on how we fare. But so far we have certainly got the markets with us, and we take it from there basically. So thank you so much for this. I could sense it's almost a bit aggressive call to some, but it's already implemented in the books. It is what it is, and we're going to take the positions and stress test these every single day and keep close in tune on developments both in Ukraine, but also now on the big driving force out there for the equity markets perspective, which is again US political risk. And quite interestingly, if you look at big financial news medias like Bloomberg, political articles are popping up again, which have been virtually, you couldn't see them for the last couple of months. So there's a lot of things are happening now which are quite interesting. All right, I will stop there, otherwise I can keep going on for a couple of hours, but thank you so much. All the slides, all the materials are on my social web pages. They're on the bank's homepage, so they're easily accessible, and please come back to us with questions, comments. All right, thank you so much.